Hey everybody, it's Ricardo Gorski, the founder of Tax One, where we help individuals and businesses pay as little tax as legally possible. And today we are going to talk about a common myth, and that is having no tax residency, because actually most countries have a residence-based taxation system, meaning you are liable for taxes where you reside in. I live in Cyprus, so I pay my taxes here on an individual natural person point of view. But now there are some folks out there that say, what if I don't live anywhere? What if I'm constantly traveling? I don't spend more than a few weeks in any jurisdiction, so I assume that I don't have to declare my income anywhere. Does this mean these people are actually tax-free? And the answer is not really, and I'm going to explain now why. So the common misconception is that if you don't spend more than 183 days in any country, no one will tax you. And while this sounds interesting and it can make sense in theory, the reality actually looks different, because there is no official documentation, no playbook, no guidelines on what a tax residency actually means, because it is not limited to the 183 days. And this is where issues come for individuals that call themselves Staatenlos. They call themselves a tax nomad, fiscal nomad, a perpetual traveler, people who geographically are independent and they don't see themselves as a resident of any country. And so they assume that they have no tax obligation anywhere because they are like a single traveling around the world with no real relationship to any country. But as I said, it looks good in theory, but the reality looks different, because the 183 days rule is international standard, yes, which definitely makes you a tax resident of the jurisdiction you spend most of your time in. But listen now, because at the same time, not spending 183 days in a country does not definitely disqualify your tax residency. So while spending 183 days definitely makes you a tax resident, not spending the 183 days does not disqualify your tax residency. It is not just about the 183 days. To make it simpler, let's look at an example. So we are talking about an UK individual leaving the UK. He wants to travel. And because UK is currently our #1 audience, because the outflux of wealthy citizens in the UK is enormous at the moment, we are talking about that, but it basically applies to most individuals from most countries, especially in the West. So the UK tax authorities are very strict. Me as a German, I can definitely understand what that means. They just hired thousands new HMRC compliance officers, so they definitely have the manpower to audit wealthy individuals. And the UK is interesting because the UK actually sees you as a tax resident. If we are talking about the days spent in the country per tax calendar year, they see you as a tax resident if you just spend 90 days in the country. But many other factors come into play as well, such as where your family resides, where they go to work, where they go to school, which public infrastructures or services you or your family uses, directly or indirectly, by the way. So even if you're out the country, but you're using a UK SIM card, you're still using their services. Where you have properties, especially where you have your permanent home with your name on the door, where your business is managed, and I'm talking about day-to-day decisions, I'm talking about board meetings, I'm talking about where your bank accounts are, private and business. I'm talking about where you have your social and economic ties, where they are the strongest, because what actually matters is where your life center is. Now, I agree. This is quite vague, especially when you don't have a life center. Because if the UK tax authorities would really want you to be their tax resident, they will find something to justify it, even if it is just you having your shoes at your parents' home. So this actually leads to the fact that only a full relocation is the proper way to go. Only a bulletproof relocation where you're totally cutting ties in major and in minor terms with your home country gives you the certainty that this country cannot claim you as their tax resident anymore. And there are quite some things that you can and have to do for that, but as this is very individual, we are advising that on an individual consultation call. Now, all of those things that we are going to explain to you and that we are explaining in other videos, by the way, so definitely make sure to subscribe, are to reach the point where you cut all points of failures. Any vulnerabilities should be avoided because there are instances and cases where individuals, even after physically moving, have been still classified as a tax resident. And we have one billionaire client who relocated from the UK to Monaco in April 2024. And he just received this letter, which I'm going to show you in a minute. Basically, his private bank reported via CRS to the UK tax authorities that they are still seeing him as a tax resident of the UK, even though he was physically in Monaco and deregistered himself from the UK and registered his tax residency in Monaco. But because of some unknown things, maybe his credit card use in the UK or basically a few factors, they still considered him as UK. And I find it interesting that it was the private bank. The banks actually had to report this by law to the UK. Obviously, it is an extreme case. It's a very, very wealthy individual. He has a lot of real estate in the UK. But now for 25 and 26, we are doing even stricter measurements so he can avoid these messages, which basically means we would like to inform you, like as if it's a pleasant email, that in connection with the application of the Common Reporting Standard, CRS, we have identified you as a non-tax resident account holder of Monaco, basically for 24. Indeed, based on the information at our disposal, it appears that under the CRS regulation, your tax residence is established in the following country: United Kingdom, his old home country. As Monaco and the above named country have concluded an automatic exchange of information agreement, the Monaco Tax Authority will send some financial information regarding your account to the other relevant tax authorities. Basically, f you, we will snitch you. So yeah, this is a very, very discreet letter. That's why I censored quite a few things here, but it is just so interesting, and such a letter is something you definitely don't want to receive from the tax authorities. And all of these things basically lead to three problems. And the first problem that we just discussed is that your home country can still and probably will still claim you as a tax resident. Not today, not tomorrow, but who knows, maybe even in the future. And believing they won't simply because of the 183 days is a dangerous oversimplification. Obviously, I get it. It depends where you are from. The UK, Germany, Central Europe, the Nordics countries, Scandinavia, all of these countries have much stricter tax authorities where such letters are much more common than if you're coming from another country, which the tax authorities are not very strict. But countries like Norway are crazy when it comes to that. They have a wall of shame, plus a 2 to 3 years waiting period where even after leaving the country, you are still considered a tax resident. Germany implemented exit taxes, luckily, after I left. And such measurements in general show the intention of the West that they want to crack down on tax havens and low tax jurisdictions, which leads to the conclusion that you have to sell your assets if you want to leave your home country and not be seen as a tax resident there anymore. You have to register an offshore company, and this doesn't mean that it has to be somewhere in the BVI or basically an offshore company. This can just be a company in the new country that you're planning to relocate to. You can incorporate the company earlier or prior to your arrival and already start issuing invoices there. Just establish your network there and start operating under your new entity there. You should move your family as well if possible. There are a lot of countries that say if your kids go to the public school in your home country, you're still using our infrastructure. So even if you live in the UAE, in Cyprus, in whatever, Monaco, we don't care. You still have to be liable for taxes here. Then you have to be radical about it. So you have to really micromanage that. You should even cancel your gym membership in the country, and you should not try to trick the system, because remember, these countries can always audit you, and that means even if you have relocated, they can still demand your documents from previous tax calendar years, and then they can even penalize you, basically fine you, or even back tax you, which is the worst thing when it comes to liquidity. Because imagine you've left the country 5 years ago, then your home country comes to you and says, hey, can we see your books for the previous 5 years? And then they say that they are false, there are voids, they have loopholes, they are wrong basically, and now we have to back tax you for previous years. This is literally the worst case scenario, and also leads to problem number 2, where the country you spent most time in doesn't necessarily have to be your home country. Many other countries can audit you as well. They get the information via CRS from the banks you are using, where you are using your credit card the most. And there are many countries like France, Australia, Canada, many other countries where they actually do investigate such stateless earners that use their public infrastructure, and then they can even claim you as their tax resident. And guys, this is my whole point here. I want to warn you, because I see it over and over again, where individuals, business owners, entrepreneurs come to us after they face the issues, because taxes is something like health. You don't really think about it until it's too late. It's the same with your health. You are basically drinking, you're eating fast food, or most people do that, smoke this and that, but then if they face health issues, they go to the doctors. But what about preventing to become sick in the first place? And this is exactly where a proper tax structure comes into play. Just have a bulletproof structure so that you don't end up facing penalties, tax audits, maybe even jail time in the first place. And this is why even special tax regimes like territorial tax, remittance-based taxation, only the money that you remit in the country is liable for tax. All of those things sound good in theory. Same with having no tax residency, and even same with the Beckham law. There is currently an amazing document, the PDF, which is Hacienda versus the People, an initial report on Spain and the Beckham law, where the Beckham law was actually intended to relieve foreigners that relocated to Spain from taxes on non-Spanish income, and they were supposed to only tax those individuals on the income they earn in the country Spain. And they are now heavily investigating those wealthy individuals that took advantage of the Beckham law, which actually comes from a professional football player, David Beckham. They basically created this regime for wealthy and famous individuals that want to live in Spain but not be taxed on their foreign income. Anyway, you can just Google this document here and then you can read about it. Very, very interesting. And the whole point is, and the point I'm trying to make here is that some of those individuals that took advantage of this official Beckham law are now facing penalties, fines, and even back taxes from the Spanish tax authorities. And here now, one of the most interesting things is the double tax treaties, because they are actually here to help you in such cases. But there is no double tax treaty that can save you, because you're not a tax resident anywhere else. And this is especially worrying if we are talking about two jurisdictions that don't even have a double tax treaty in the first place. And this beautifully leads to the next point, the next problem, which is the citizenship-based taxation. And this is the latest stage for individuals having no tax residency where they will get taxed. And even if you find arguments for the first two problems, your home country claiming you as a tax resident, the country you spend most time in claiming you as a tax resident is not really worrying you, then this should worry you. Because the US, they have a citizenship-based taxation for over 160 years now, which basically means that the taxation is on a passport level. As long as Americans hold their US passport, there is basically no real way to avoid taxation. Meaning if you hold a US passport, any income that you generate is liable for a 15%, something around that, withholding tax, which goes straight to Uncle Sam before you even see the money. And this is fundamentally very different to the residence-based taxation that we have in Europe, for example, where the US doesn't even care where Americans reside. They say 15%, something around that, belongs to us until you renounce your citizenship, which is basically the only real legal way to avoid this citizenship-based taxation. Now, as said, we don't have it in Europe yet. But I'm gonna explain you why I think that we might see a very similar system in the near future. And that is, let's look at those statistics here. This is the millionaires' migration over the last few years. And what we are witnessing here is the largest wealth migration in modern history, where in 2024, 134,000 millionaires relocated globally. You can see it here. We literally reached an all-time high of wealthy individuals leaving their home country, and at the same time, we are looking at 500 billion to over 1 trillion in assets that move from countries like China, UK, India, South Korea, Russia, Brazil, and a few others to countries like the UAE, US, Singapore, Canada, Switzerland, Greece, Portugal, Japan, and many other countries where there is an upgraded lifestyle compared to these countries here, where there is more safety, a better tax system, a lot of advantages that millionaires appreciate. And now, even I, myself, am a perfect example for that, because I left Germany 6 years ago, where I started to make some money online, and I moved to Cyprus. Now, just imagine the German tax authorities looking at Ricardo Gorski, living in Cyprus, making YouTube videos, helping other people leave Germany and just move to low tax jurisdictions, driving a supercar, wearing expensive watches, and obviously having money, but he's not giving us anything. But didn't he grew up in Germany? Didn't he go to school for free? Didn't he use all of our facilities and amazing infrastructure and blah, blah, blah? Yes, he did. We want something out of it. And so all of these jurisdictions and governments and tax authorities, they obviously see what is happening. We have the statistics right in front of us, and this is the whole point of them starting to crack down on low tax jurisdiction. This is the whole point of Germany implementing the exit tax right after I left. This is the whole point for the global minimum corporate tax, the GMCT, coming from the OECD, the Organization for Economic Cooperation, where they basically force tax havens and low tax jurisdictions to increase their corporate tax to at least 15%. And this is the whole point why the UAE, Dubai, recently increased their corporate tax. They were 0%. Now they are 9%. Most likely they will go to 15%. Cyprus, 12.5%. They are just proposing the 15% corporate tax, which will be most likely implemented as well. So this is the first point. Another point is the targeted universal tax. Coming from France, France is the first Central European country that is discussing basically a worldwide income tax, a citizenship-based taxation, you can say, where they also say, we don't care where French people reside, as long as you have a French passport, you were born and raised here. We want to see some money. Withholding tax, 5% flat. Can look something like that. 10%, 15% like the US, who knows? The French government is literally one of its kind. But this is not my point. My point I'm trying to make here is that this proposal, in my eyes, is just a test to see how the society, how the people will react to that. They are planting the idea of a worldwide income tax, citizenship-based taxation in our heads, and then in the near future, when they then will actually implement it, it is not a huge surprise. It will not be a shock anymore because, well, we talked about it and we proposed it here and then. And this is exactly the same what they did with the lockdowns and the mask obligation during the pandemic, isn't it? First they said, no chance we will do lockdowns, no chance we will restrict your freedom and basically force you to do the vaccination and mask and all and that. And then what happened a few weeks, months down the line? This was basically the case. So in my eyes, I would definitely bet that we will see a similar system somewhere in the near future. I wouldn't be surprised. They already planted the idea in my head. I'm already doing my preparations and my plan B is already in process, so to say, but this is a topic for another video, citizenship-based taxation, if this is interesting for you as well, and how to basically prevent yourself from such a scenario. Make sure to subscribe to the channel. Now let's talk about double tax treaties again, DDT. And here I found out something really worrying. I've not seen anyone else talking about that online but me. And this is the first time I'm talking about it online actually, other than on my Instagram account where I posted it a few days ago because I was literally in shock when I found out about it. And here I found out that on January 1st, 2022, the German tax authorities or the German government and the UAE didn't renew their double tax treaty, which obviously was the decision of Germany, of course, and not the UAE, because it's in favor for the UAE to have double tax treaties. And what is happening here is, in Germany, it's quite a viral thing to talk about Dubai. It's always in the news and the daily shows, and all the politicians and mainstream media are basically talking very bad about wealthy individuals and famous people leaving Germany for Dubai. Dubai is like literally the second enemy next to Russia when it comes to German media. And what they did in 2022, in the beginning of 2022, is they didn't renew their double tax treaty. And what does this mean? And what this means for German citizens living in the UAE now is no one is legally protected from a double taxation. So, if the Germans were to implement a worldwide income tax, then all individuals in the UAE are legally required to provide documents for previous tax calendar years where they declared their personal income. And then, if they see that this was the UAE, which has 0% income tax, which is nice, but then the German tax authorities will say, well, that's nice for you, but we don't have a double tax treaty with the UAE. And so you actually are liable for worldwide income tax. And this is why you have to pay income tax for 2022, 23, 4, 5, 26, whenever they will actually do this and send such letters to Germans living in the UAE. Now, Germany is not the only country. Norway, Sweden, they also don't have a double tax treaty with the UAE. Interesting, it's the Central European countries and the Nordics again with their strict tax authorities. Are they maybe preparing some kind of coup where they want their wealthy citizens to make as much money as possible for a few more years and then basically hit them with a huge tax bill in a few years from now? Because why sending them a letter now? I mean, we've seen the statistics. We are literally at a peak of entrepreneurs leaving right now. They can also just wait 25, 6, 7, and then boom, huge business. But yeah, all of this sounds worrying enough. I don't want to be too negative. Now let's talk about solutions. And my solution here is just forget about the stateless earning thing, the Staatenlos thing, the tax nomad thing, no tax residency. I would never be able to sleep well. When it comes to that, we are never advising it to our clients. What we advise is get a simple but safe tax residency in a low tax jurisdiction that has double tax treaties. And in my eyes, I don't want to sound biased, but it's literally the Cyprus non-dom status, where you can become a legal tax resident with just 60 days that you spend in Cyprus and some other requirements that we are also happy to advise in an individual consultation call. You will enjoy 0% tax on your worldwide dividend income next to other tax benefits such as 0% capital gains tax, low corporate tax, and the main point here is you will get an official certificate guaranteeing you that you are a non-domiciled individual in Cyprus, which gives you those benefits for the next 17 years. We have double tax treaties with most countries, and you can keep traveling for 10 months during the year, wherever you want to go, Thailand, Bali, European countries, whatever there is. Like, I visited a lot of countries too. I lived in Bali, I lived in Thailand, I just visited the UAE, I lived in Switzerland. I love traveling as well. But I just love having a home base, and for me Cyprus is not just the best from a lifestyle perspective, but also from a business perspective and from a fiscal perspective, where I'm enjoying the non-dom. And I'm already living in Cyprus for 6 years, so I have 11 more years, but I think that's enough time to make a lot of money. And once you are a non-dom in Cyprus, there are a lot of possibilities and options for further optimization. It doesn't mean that you have to have a Cyprus limited company. We can look at other jurisdictions as well. But again, this is where an individual consultation call comes into play. And guys, as I said, I love traveling as well. I literally visited so many countries. I just came back from a 2 months Asia trip, and I would wish that it would be as easy as just being Staatenlos and traveling everywhere. But as long as there is no official certificate, a literal physical piece of paper that is guaranteeing you that, what a lot of people claim, then I don't think you should take advantage of that. And I know there are other individuals saying that Staatenlos is a thing and it is possible, and maybe it is. But taxes is such a complicated thing where you can't rely on someone else's words. You literally need a physical guarantee that you will not face back taxes, penalties, audits, investigations, because you don't want to end up in the Panama Papers 2.0. I'm literally reading it right now. And all of the people that went to Mossack Fonseca, the lawyer firm in Panama, they also thought that it is safe until it wasn't anymore. So guys, you don't want to end up in a book or into an investigation like that. This is my last point here. And if this video was interesting to you, if you want a bulletproof structure and pay as little tax as legally possible, reach out to us on tax.one. And if you subscribe to the channel, I will see you in the next video.